It is Yes Bank and it is Idea Vodafone. Those are two stocks which are really bucking the gravity. Yes Bank, when I say bucking the gravity, it's recovered from the day's low. The percentage hike, absolute change is not high, but the percentage change is happening. But the bias or the trend for the stock is up on a day when markets realize that Yes Bank has done and reported another divergence of 3,000 crore. But Vodafone and Bharti, that's where the magic has happened. Saurabh Mukherjea, good morning. Thank you for joining us. There is every reason why one should not buy telecom stocks. If you have 5, I'll give you another 5. If we both have 10, somebody will give us another 5. In next 10 minutes, we can find 15 reasons why one should not buy telecom stocks. But yet, Bharti is at a 52-week high. What is going on?
I guess there's probably enough people out there who sort of hoping that that the industry consolidates around two players and Bharti benefits from that, from being one of those two players. So I don't see any other logical way to understand this other than the fact that a number of investors out there are making a punt that in a two-player industry, Bharti will get its fair share of spoils. So I can't give you anything more substantive than that, I'm afraid.
Yeah, look at power. I mean, can we imagine our life without power? The answer to that is no. But have shareholders of power companies made money? The answer to that, at least in India, is no. So do you think telecom is like power? You need telecom, but for a minority shareholder, telecom companies will struggle now?
I think the most regulated industries in India are similar in that, whether you look at airlines, whether you look at telecoms, you look at power, generally infrastructure, real estate, wherever the regulatory construct is such that the regulator or the government will call the shots in terms of who gets in, who stays out, what are the rules of the game. It's very difficult for minority shareholders to make any money. So that's a rule of thumb I've followed in my 11 years in India. Stay away from sectors where the government or the regulator basically determines the rules of engagement, because in such a sector it's very, very difficult for minority shareholders to make money, whether that be telecom, power, real estate, or indeed airlines.
Saurabh, hi, morning. The big news this morning, of course, is that it seems, at least the 18-hour sources seem to be indicating that BPCL, Concor, SCI disinvestment is something that the cabinet is going to be taking up today for a decision. Earlier also, Saurabh, the finance minister has indicated that disinvestment process is going to come to a close, and she hopes to close in on that by the financial year end. Would you say, though, that the best is already in the price somewhat?
So I'm not so sure, how easy it will be to make money from, high quality privatization plays such as BPCL and Concor. I think both are actually very good quality assets, but I'm not so sure how easy it will be for minority shareholders to make a punt on them and make money. What is more encouraging, what is more, I think, upbeat for the market more generally is that the government is clearly saying that in the next 6, 7, 8 months, we'll move towards privatization or large stake sales. That is probably the most bullish step forward towards privatization. We've seen for I think 14, 15 years. I think the last major privatization wave was NDA 1, good 20 years ago. So beyond the stock specifics, I think this sort of momentum for selling class assets is indeed very encouraging for the market as a whole.
You've been pretty candid about where you see the recovery coming in and the fact that it's going to take time. However, it's an interesting mix of stocks that you continue to pick up or find opportunity in. What's the overarching theme? Is it domestic focused names? Is it valuation? What's the overarching theme that you're going with in the current environment?
So what we are primarily doing and what we've done for the last couple of years is that given the degree of underlying uncertainty in the economy, what we've been doing is look for companies where we know with a very high degree of certainty the books are clean, the numbers are real. I think I just heard you guys were discussing a prominent bank a few minutes ago. So we spent a lot of time looking at, are the numbers clean, are the numbers believable, lots of forensic work. Secondly, we look for companies where the products are as close as is possible to be essential for day-to-day life in India. We're trying to avoid companies where the product is discretionary in nature, where the purchase is discretionary in nature. And the third thing is barriers to entry, right? Clean accounts, essential products, all very good to have, but you need to have barriers to entry to make sure the competition doesn't come and take your profits away. And when we find such companies, we go and buy as proactively as we can, without spending too much time losing sleep as what is the PE multiple yesterday morning, what will it be tomorrow morning. We found in India around 20 such stocks, dozen and a half are already in our portfolio, and hopefully in the next year or so we might find a couple more stocks like this. As and when the economic environment becomes more fertile, less hostile, we might be a little bit more adventurous in our stock picking. But over the last couple of years, it's been a very tightly defined mantra: clean accounts, essential products, very high barriers to entry.
Sunil Singhania on my show last 10 days ago actually, and he said, look, buying a good business and buying a good stock are two different things. DMart is a great company, Indigo is a great company, a classic compounder which you own, something like Aventus, it's a great company. But if you're buying them at P multiples of 50, 60, 70, the chances of making double-digit returns for next 3 years are very, very rare. And he's given a lot of global examples where he says that, look, if you bought classic companies in US also at astronomical P multiples, you don't make money. So do you think somewhere that could be a challenge for you, that you those classic compounders which you like, which are based on previous history, which are based on return ratios, which are based on ROE and ROC, they are outpriced right now?
No, I think, look, Sunil Singhania is a long-standing guru, a friend. I've learned a lot from him in the years to come, and we hope to learn a lot from him in the years to come. So I learned from him 2 years ago as to how to think about setting up an independent asset management business. Whereas what Sunil is saying is, I think by and large is bang on the money. If you try to do what we are doing in India, you try to do this in America, you will get slaughtered. In most efficient markets, UK, USA, Germany, Japan, it's very, very difficult to maintain return on capital at 40, even 30% over an extended period of time. Most glamorous, well-known American firms, Japanese firms will have return on capital of barely 15%. If they get to 15%, they'll be celebrated on TV channels in America, on the covers of magazines and so on. Our country is unique amongst the world's 10 largest economies. We are the only large economy where we have around 20-25 companies whose ROC is a million miles above their cost of capital for decades on an end, right? And when we say million miles, I'm saying 40% ROC for a very extended period of time. If you can keep return on capital so far above the cost of capital for an extended period of time, it gives you a mountain of free cash flow. And if you keep reinvesting that rather than getting greedy and buying private jets for yourself, if you keep reinvesting that money in the business, what we've seen in India over the last 5 years, the last 10 years, the last 20 years, even the last year, what we have seen is if you keep reinvesting that, you've got a very high chance of keeping earnings growth around the 20%, 25% mark. And if you take one example of the several in our portfolio, this is exactly what Asian Paints has done for the last 3 years, 5 years, 10 years, 20 years, 30 years. So Asian Paints 20 years ago was trading at exactly the same PE multiple. Asian Paints over the last 20 years has given, I think, close to 100 times returns. Nestle 20 years ago was trading at pretty close to the same multiple. Nestle over the last 20 years has given close to 80-90 times your money back. So I don't know about the next 3 weeks or next 3 months, but I am pretty confident that if we carry on focusing on this type of company, very high barriers to entry, as a result return on capital well above cost of capital, as a result plenty of free cash flow, you chug it back into the business, whether you're Asian Paints, whether you're Pidilite, whether you're Dr. Lal Path Labs, you reinvest the free cash flow back in the business. In a poor country like ours, the growth potential is immense. Even in a downturn, you're seeing these companies, Asian Paints, Dr. Lal, even Page Industries, which is a big part of our portfolio, give you volume growth numbers anywhere between 9% to 19%, which gives you a sense of how far we have to go in terms of development in our country. So PE-based investing has a big place in everybody's portfolio. In the West, PE-based investing, value investing as it's better known, is the definitive way to manage money. By and large, it works in India as well. There is a small set of companies in our country which are able to keep return on capital very high and thus earnings growth very high. And if there you invest even at 100 times PE, we've shown over the last 3 years, and in my books I've shown over the last 20 years, you still make very healthy returns, high teens, low 20s return. And as I've said on your channel, if I make high teens, low 20s returns for our clients consistently, I think that's a pretty decent outcome for them. We're not claiming we can do 30-40% return by timing the market or by getting the PE multiples right, but high teens, low 20s consistently by buying great compounders, I think is very doable in India.
Okay, all right. Saurabh, a couple of pockets, of course, where of course you're completely staying away from currently: power, metals, real estate, and so forth. If we do see an overall pullback, which we're already starting to see when it comes to the markets, regardless of the fundamental or growth indicators, do you see more participation nonetheless across the board?
So I think, look, the most interesting one will be auto, right? And as we all know, October has been a pretty decent month for the auto sector. I think everybody's trying to figure out whether October is the beginning of the auto revival or whether it's a flash in the pan. What we've started to do in some of our clients' portfolios is selectively buy one of the two-wheeler companies. I'm not at liberty to disclose the name, but we're buying one of the two-wheeler companies in some of our clients' portfolios, not because we expect the two-wheeler revival to have begun a month ago and from now on it'll grow, but given the quality of the franchise, the high ROCs, high cash generation, the sheer quality of the corporate governance there, we felt that said two-wheeler company was just too deliciously cheap to be ignored. We'll see if the two-wheeler company carries on showing us that even with low volume growth they can hold up their business. We might buy some more. I'm not so sure cars and trucks are going to recover quite as quickly as two-wheelers. I think of the three, two-wheelers, trucks and cars, I think two-wheelers are the likeliest to recover quicker because the ticket sizes for purchase are smaller. But I think this is probably the biggest sector if one wanted to look and say, how do I play a potential economic recovery? I would say more than cement, more than steel, more than real estate, I think two-wheelers would be auto would be the industry to look at. There are several good auto anchors which are absolutely smashed in terms of valuation. And again, these are cash generative companies, balance sheets are strong. So auto anch would be my favorite play on the economic recovery as and when we get visibility on the same.
Saurabh, great to have you on the show. Thank you so much for taking the time out and joining in today. That's Saurabh Mukherjea from Marcellus. Quiet start for the market. Reliance, though, marching close to that 10 lakh crore rupee market cap club. Just 22 points and we should make it there. Should happen today, hopefully.